Welcome back, everyone. Happy Friday. Happy Good Friday. I guess we have some markets open today. Anyways, I'm looking forward to most of the day being off and using ChatGPT, finding more stocks. That's what I've been doing a lot recently, and pretty fun stuff. Um, we had some good podcasts this week. I really enjoyed the Floor and Court, and this is a very unique firm um, that trades lots of markets, and well, they say none of the normal conventional markets, CME, IMM, things like that. So pretty amazing. And they're adding 50 markets a year. So that's interesting. That's good stuff. Pretty secretive group, but I enjoyed the podcast. And of course, I got a chance to dig deep into Richard's podcast two or three times and listen to that with Niels. That was very interesting, very good. And I think a good place to start or get into later would be something like, the recent movements in the markets and the give back in the interest rates and the volatility, the drawdown, and the correlation. So those, I had some new thoughts on some of those things, and Oleg is trying his best to talk. He's trying to get his technology squared away. But yeah, so a lot of good stuff on there on Twitter and the podcast. I listened to a pretty good podcast yesterday with Taleb, and he's getting a lot of crap today from Cliff. But Cliff outdoes everyone. I try to be a bit, controversial or a bit stir the pot. And wow, I'm in the minor leagues when it comes to creating controversy on Twitter. Oleg, how?
Hi to everyone. Hi Jerry. Hi Moritz. Hi Richard. Hi Brian. Hi Seth. Alp. All the guys I can see here. I'm very happy to be here, as I always say, and I'm sure that I will always say this. The only unhappy thing was that it was very bad technology problem. Hi Bruno, by the way. It was very big technology problem last session, and so maybe I have heard maybe 3, 4, 5% of conversations, and it was awful, to be honest. So this week I was thinking of, as always, for maybe 10 or 15 years, I was thinking most of the time about the markets, thinking about benefits of long-term trading and about short-term trading, and I thought that in short-term trading, we need, it's my opinion at least, we need some improvements, we need we need some filters and so on and so forth to improve short-term trading. If we do the same, and if we are doing long-term classical trading, we don't need anything. We need only add new markets. I did the research. I did a lot of them, but I did research this week, another research, and if we are talking about classical long-term trading, medium long-term, that we can't, in fact, improve this. It's perfect. And when we are talking about short-term trading style, I think that we need to do something with exits, because we'll say this, and I have said before, it's a problem with whipsawing situation and costs. So one of my thoughts. So I hope that this session will be without technology problem.
Thanks, Oleg. Yeah, I wanted to start out with Richard because I was really interested in his thoughts on he talked to Niels about the drawdown in interest rates and the correlations and the volatility, changing your systems, using it as an opportunity to evaluate your systems. And I enjoyed that part too about DBMF. I don't have the numbers for DBMF and versus the index, and Richard produced that and said that it's still hanging in there, and it's still ups and downs, but it's not too. It's still right where the index is over the long term. So that's good for Andrew. Anyways, how are you, Richard?
G'day, Jerry. G'day, everyone. Yes, look, it was a good conversation with Niels. I think I posed this question in relation to something we discussed last week on Spaces with the Spaces last week about the impact of the March impact on those trend followers who had what I'd regard as overly exposed to fixed income markets. So, there are some monthly numbers now coming in, and I notice that quite a lot of the CTAs are pulling in excess 10% adverse moves for the month. And look, I know we often talk about this adversity with these short, sharp corrections as being something that we've got to, buckle up and ride on. But when it comes to the level of extremity of these things, I think there is a point in time where you've got to ask yourself a question: was that too extreme, that adverse move? And, I'd be considering a monthly move of plus 10% to be too extreme, because when I look at the monthly returns of the indexes and the individual programs, when you do see adverse moves of greater than 10%, you start that starts losing the positive skew of any program or index you're tracking. It's too extreme, in my opinion, especially when you look at the other side of the equation and you say, well, if my maximum monthly returns have been 15 to 20% and my adverse returns have been 10 to 15%, well, there's not much differential between that. And for our models which cut losses short and let profits run, you've got to question that and say, how did we have such an extreme event? And ultimately it comes down to, well, if you do have such an extreme event, it clearly lies in the level of correlation exposure you have in your portfolio or the level of leverage you have in your portfolio. So one thing I personally believe, and Florin Court brought this up as well, I think that there's a lot of programs out there that are attempting to apply correlations, apply smoothing scenarios to improve their smooth solution by dabbling in alternate strategies that take the distinct properties of trend following and dilute them, and they get these smoother returns. But Florin Court argued, and this is what I'd also be arguing in our classic trend following camp: if your level of move is too extreme, it does mean you're overexposed to that particular sector. So the way to accommodate that without having to go into these alternative tricks of the trade, like dabbling in long vol, highly convex option strategies, those sort of things, without having to dabble in that, or short-term systems or overlays that smooth the curve, the way around that, of course, is to look at further diversification of your portfolio. And I personally believe that is one of the big central solutions that we should always turn to before we look at other solutions. So to me, if you're overly exposed to fixed income, or you've got too high leverage to fixed income, the way around that is to further diversify your models, reduce your bet sizes smaller, diversify into alternate markets. I love Florin Court's approach, and I think that the more we address going into these alternative markets, particularly some of these youthful markets, I keep on going back to Perry Kaufman, where he talked about the nature of trending conditions in these quite youthful markets, those without a long-term track record, those with a short-term life cycle. They tend to offer significant trending opportunities. And I noted that Doug Greenig from Florin Court said that while they can always argue competently that diversifying into alternate markets is always beneficial to your strategy because it always reduces the correlations in your portfolio. He said there is another strong argument which they feel is harder to prove, but it's definitely something that's warranted. And he was saying that he thinks that these alternative markets trend better. And I tend to totally support that idea because I think as trends, as you get more and more participants in a particular financial market, I do think the nature of trends in those markets becomes much more complex, much less distinct, harder to trade, much more volatility in them, much more noisy in them. But things such as these, alternative markets, palm oil, all of these sort of things, different sort of markets which do not have significant participation in them but are still sufficiently liquid, I think you could probably argue that they probably do carry with them better trends. I'd be very interested to see what everyone else thinks about that.
I want to say about this because I was thinking about this maybe for 2 or 3 weeks. I was thinking about this topic maybe 100 times, maybe more. So I want to say the following, that in my opinion, in these alternative markets, these markets are small. And when it's my opinion, maybe I'm wrong, but I think that when we see a massive flow, when this market get to be interested by the people, by the investors, they pour money there, pour money in that market, and there is no need to a large amount of money to be poured in the market to have a big movement. It's my idea. Maybe my English isn't perfect here, but I think so. So really, the smallest markets have the ability to trend better, I think. But of course, maybe as a trend followers, we must trade all the liquid markets because all the markets have the ability to be in trend. But my opinion that really there is a lot of interest in these alternative markets, and I like small cap stocks, mid cap stocks, and really it's very interesting. I was watching them this week also a lot. Very interesting.
I'm skeptical about the smaller markets or the newer markets being better than the other markets. It's possible. Number one, we can't look at it that way too much because we have to include all the markets. The expectation of our system is the expectation of, after we add up all the markets and not just, and sorting the markets based upon their own historical performance is something that you kind of got to stay away from in your back testing. And, they made a lot of money last year, and he talked about some interest rate swaps. So to some degree, look, we all do things, but maybe it's just like a marketing thing to some degree. We don't trade these other markets. We don't trade sugar. We don't trade interest rate futures that in CME and ICE, but they're probably in markets that were very similar. And they miraculously had a great year, like everyone else had a good to great year. So I'm a little skeptical of that. You just have to look at the numbers, but I think it's difficult to even be convinced when you start sorting and reducing your sample size. It's kind of interesting that and obviously last year some of the bigger performer numbers most assuredly traded a lot of interest rates. In my opinion, too many. I'd say rates are my smallest sector of the four because there are fewer markets. But I still did well in the rates last year, but it's a pretty good evidence that when the rates have a really big drawdown, those same people had a really big drawdown. And one of the ways that they talk about mitigating these problems is correlation and volatility management. That's right. Some of these big numbers are coming from the biggest vol managers and correlation managers, according to themselves, out there. So now, where was that vol management and correlation management, right? I would assume, I mean, these positions since entry are the ATRs have dramatically increased. But so maybe they just trade very large, and they're ready to cut risk very quickly based upon this their correlation and volatility management. So they have these things in there that to help out with these drawdowns that we don't like. We're the ones who should have had the bigger drawdowns because I never changed my position in euro dollars, and the ATR, God knows how much it increased from 5 to 30 or 5 to 20, 25. I don't know, but it was a massive increase. So maybe not using a realized equity trade level is another problem that they got hit with because their equity was at all-time highs pretty much to start March. So they had on max positions. I think a lot of it, and I've tweeted this before, I don't want to rely upon my speed. I'm really pushing it here with my trade level and my big aggressive positions and then overtrading the interest rate sector. But, if I see an inkling of vol heat up or correlation heat up, I'll swoop in like Superman and reduce everything very quickly. Crisis averted. I don't know. Wasn't much of a crisis averted, I don't think. What do you think?
Hey, good morning, everybody. It's Moritz here. A couple of thoughts. First of all, I think that we cannot forecast and we shouldn't forecast which markets will be better trending versus others, because if we could do that, then we should only be trading the markets with the best trends in our expectation. But, we just can't make that prediction. So whether these alternative markets or the newer markets, less liquid markets, call them, have better trending characteristics or not, I just don't know that. So I agree that we need to trade all of them, but I'm a big fan of adding these markets if and when they are really different. If they can add an independent, uncorrelated exposure and return stream to what we already have in the portfolio, then that is, and it should be very interesting for us to add that market because it has the outlier potential, it diversifies our risk, it gives us more opportunity, and all these type of things. And I guess what we would need to do then is put that in perspective or in relation to the risk and maybe the inconvenience that we would have when trading these markets, because many of them are OTC, which means all of a sudden you're moving away from essentially the tried and tested relationship that you have with your execution and clearing brokers, where either by the click of a mouse button or through a fixed connection or whatever way you do it, you essentially trade and get cleared, and the counterparty risk is only to the exchange. That now changes and it becomes bilateral and OTC. It doesn't mean that that is necessarily worse, because that depends on the agreements that you have in place with your counterparties and how often you exchange collateral versus P&L. Some of that can be just as safe as a centralized exchange, I'd say. But there are hidden costs, in doing that. I mean, one of the costs is the legal cost in negotiating these agreements. And then there's other costs, for instance, in the onshore China commodities, which aren't really that easily accessible for people. You need to have other counterparties involved to kind of like stay away from mainland China if that's what you want to do, if you don't want to have a physical trading presence there. And then there's obviously fees involved for, which the counterparty that you're using charges. And these fees can be relatively high in some of the markets. Another example is regional carbon credits tends to come with relatively high trading fees. But then there's markets such as power and gas and freight even, which I think is very interesting, that are liquid. They're just not on the exchange, but they're big markets and you can trade them without a high fee drag. And that's just something that I'd love to get to. And again, I'm not predicting that these markets will be trending better or making me more money. I just want to add them because I think that they'll be different and that they can help me. But it shouldn't be too inconvenient, and it shouldn't come with a bunch of unnecessary risks. Like, if it comes with a ton of counterparty risk that you cannot negotiate away or mitigate or address, then I wouldn't do that. Then I'd rather be safe as opposed to sorry at a later point in time. But any of these markets is great. I'll stop here, but later on, I have a few more thoughts on what Doug Grenick said on the way he, I think, reduces exposure, essentially taking profits when markets have run as he's expecting more volatility on the downside when these trends break, something that I don't do. And I think he also said something that he's trading some markets faster, FX, for instance, because they're liquid, than other markets. Yeah, again, I'm not doing that for sample size reasons. I can see why they're doing it, but I have my views on that. But I'll stop here.
Yeah, thanks, Moritz. And I agree with you. I would even go a little further and say I would trade those markets, would love to trade them. It's my goal to trade all these markets, China, everywhere, even if they were a little correlated, because, and I do that now. I'm always adding markets. I added 3 interest rate ETFs this week: short-term muni bonds, short-term tips, short-term corporate. Well, they're a bit similar, right? There's a tiny bit of difference. I have some of these ETFs and even the futures, the 2 years, the Aussie 3s and 10s, they're hitting new highs. And so you're going long. European interest rates, you're kind of still shortish. The positions are a bit different. They're sort of correlated. It's just the randomness of the chart pattern and the breakouts that's giving me some diversification on positions, but not on daily P&L necessarily. And so I'm perfectly fine adding, as I have, crude, Brent, WTI. That's our classic example. Like, if you're going to trade WTI and crude, then you're not that concerned with correlation. And so I'm kind of concerned with it. I appreciate diversification, but I'm adding these markets, and I've gone from 20 interest rate contracts 2 or 3 years ago to 40, and I trade each one of them small, and my allocation to interest rates is about the same. So I'm just continuing to dice up that risk budget in that particular sector, like I did in the currencies and stocks and commodities, as much as I can. So, and they're correlated, and then they're not correlated, and then you get the big outlier because it was correlated, but it made 100 ATRs, and everything else made 30 or 20. So I'm, yeah, and they are kind of predicting. It's a marketing thing, It's one thing to want to trade 500 markets and add all of these markets, and OTC, which Niels has some concern about, and I don't disagree necessarily about things that are not futures related or exchange traded. But to sort of say, well, we're going to not even trade those New York, Chicago, London, ICE, CME markets. We're only going to focus on these alternatives that none of you guys are trading. And we're going to add 50 more per year. I'm like, what the hell? Where are these markets? Where are these 50 per year? And this is a closely guarded secret, I'm sure. So, but it's pretty interesting. And I do applaud them. And I would just trade all the markets. So, even the weird ones and even the ones I've traded for 35 years, I would continue. Obviously, never going to give up on my sugar and OJ. And we're coming off this incredible period of 3 years, which I've never seen in my systems have better 3 years, risk adjusted. I've traded larger and made more money, but the trends were amazing, and it just kept getting better and better. And then, so I'm not going to abandon these markets. I don't really know the the endogenous moves happen. They happen regardless of who's trading them and how many people are trading them. And we haven't seen too many massive trends we participated in, even though we've seen painful givebacks. We haven't seen total collapses where we could look back and say, oh, yeah, that market collapsed, and we gave back all of this 1 to 2 year profit, or way too much of it, because there must be too many people trading it. So I'm not really anxious about these markets, certainly given recent performance.
And it was so fascinating. I was very fascinated when I saw that. I did a little research and I saw that the most correlated sector is fixed income is the most correlated sector. And if we trade different counters, different ETFs from this sector, it gives a lot of benefits in diversification sense. So diversification gives benefits and much benefits, even if in a very correlated sector as fixed income. So diversification is great.
And I'll start off this thing about you were mentioning Moritz, if you want me to, but yeah, it's just shocking when you listen to all these CTAs that Niels has interviewed. I mean, I guess I'm not shocked, but it's just interesting about how far away they can get from what I would consider to be safe, robust, classic trend following. And trading market's different, time frame for different sectors. I'll trade this sector faster. I'll trade this sector slower. Yeah, it's kind of. Oh, and Doug went so far as to say trend following is. I mean, I'm putting words in his mouth. I'm paraphrasing here, but this is kind of the impression I got. It's like trend following desperately needs this vol management. I mean, you've got to have this vol management. You cannot trust that breakout trailing stop. Well, I I mean, I'm one person, but I can trust it. I've been trusting it. I've been giving back more I've been having more open trade profit, unprotected, than who has more than me? Who has looser pants? Who has given back more good profit? Who is more bumpy and more and less smooth? I mean, when it's all said and done, it kind of doesn't work out so bad. You win some and you lose some. I have these massive givebacks of profit, and then the market goes back to new highs. I can list them all for you, and then I have massive givebacks of profit, and the markets keep going lower, and I give back too much, quote unquote. So, I mean, it is really baffling. And once again, I think there's no proof in the numbers that this is the case. But once again, how are you going to prove that when there is no proof? Well, you got to throw in Sharp. Oh, well, Sharp. Well, volatility, risk adjusted. Oh, well, sure. That's why I don't use Sharp.
I think that if we are trading sectors in different speeds, I think it's kind of prediction and it's not our philosophy. I understand why people trade in different speed to diversify, but the same markets, to diversify their portfolio. I understand this, but trading the different markets in different speed, I don't agree with this. I think we must apply universal laws for all the markets. It's our philosophy.
Jerry, do you want to talk about DBMF?
Yeah, I was very happy about DBMF and your analysis of it. People were posting things. Yeah, okay, so I was reading some of these posts and I was getting irritated. So last week, and people are bashing. Oh, yeah, I got a text from a friend of mine, and he goes, "Hey, Jerry, I'm in LA at a conference, and I guess they're all bashing DBMF, right?" Because he goes, "People here are telling me you like DBMF. I mean, this cannot be true." I'm like, "What the hell are you talking about?" I love Andrew. I love DBMF. It's a great product, and so they mischaracterize it though. And one of the things that was posted was something along. I don't know, and I'm not obviously an expert on replication. Okay, so I'm sure. I mean, I think I know how it broadly works, but so Your points were brilliant. Like, it's more volatile. Okay, sure, it's 14 markets. That's great. It's still hanging in there. It has its ups and downs. Sure. But one of the things that they posted was it doesn't have money management. And they need all good CTAs need to have money management, And I'm thinking, no, that's all of these 20 CTAs. They have entries and exits, position changes based upon entries, exits, stop losses, vol management, correlation management, and whatever you want to call risk management. And he sees how these positions change as a group of 20. He replicates that with an algorithm, and he says these are the new positions. Now, maybe he got caught up in not doing it quick enough because the markets were really pounding. And I'm sure even though these CTAs who've all managed lost a ton of money last month, they still were doing trades. Maybe it could have been worse if they hadn't have done this. And so he was late possibly, so he maybe lost more money. He only trades 14 markets. That's obviously going to be a problem sometime and a benefit. But their money management shows up in his positions. So he doesn't need money management, and he's not trading without money management. He's trading with money management, with their entries, with their exits, with their stop losses. So there is no point here that, it's really risky because it has. What do you think, Richard?
If I knew what was under the hood of the CTAs he was replicating, because he's dealing with the SG CTA index, and after now that I've listened to a lot of the people on Niels's podcast, I would actually probably say that probably the vast majority of them probably don't trade with stops, to tell you the honest truth. I think probably once again, this is where we sit ourselves outside that with a more regimented risk management model that uses these classic risk mitigation mechanisms. And I think that these CTAs that he's replicating are using other methods such as volatility control, dynamic position sizing, aggressively scaling volatility, all of these things, which are their proxy for trying to mitigate risk. So if Andrew is replicating them, then obviously his performance will reflect their method of risk mitigation. I'm not so sure that they are aggressively managing risk to the same style and nature that we do ourselves. But Moritz might be able to add something here.
Yeah, I don't think they do that because they're missing the stop. And a couple of months ago, there was a podcast, I think, with Mike Green and the Altic, I think, CTA manager that manages an ETF for Simplify, I think they're called. And I'm just, in the back of my head, it's when you do these regression-based optimizations, you come up with a portfolio that is looking back in time, but you might be ill prepared for a shock. That's just the concern that I have, especially on a portfolio that has only a few markets. I think 14. If something goes really wrong with any of them, it may take a while before you get out because you're missing that protection. You're just giving up on that. What we think we all love is to know that we're protected, to know the level where we're going to get out. That's the point that we honor, and then we close the position and start over. And in the absence of that feature from that process, that really is the only thing. Maybe the lack of markets or them having not many markets is another one, but the absence of that stop is something that I would critique.
Well, but look, none of these positions were subject to a stop loss. So these were massive open trade profits for Andrew and for the group of 20. And so none of that, he was loose pantsing, replicating somewhat of a loose pants. These guys are really large traders, so they don't, they have a holding period similar to mine probably, except for the vol management and the correlation management. And so, evidence, they were letting profits run. They were having somewhat loose pants. They themselves could not turn around and reduce those losses as quickly as they want to, even with their daily adjustments due to vol management. Or they did, and if not, they would have lost 20%. So twice as much, let's say. So I don't know. It's a little bit of a mystery. But this is totally normal, and these moves were totally in context with most of the firm's profit, open profit, and the returns that they've had over the past year or so. So yeah, you make 60% and you lose 10. I mean, of course, my return would be very, very. The ratio of that would be similar for me as well. I just trade smaller, so there was no stop loss here, and then the way that they mitigated this was not through negative skew systems. It was through things we don't agree with, which is vol management and correlation management. So their guilt was trading, if you even want to say that, was trading a lot of bonds, and maybe they habitually trade too many bonds, and it's going to bite them again in the future by not taking advantage of more diversification. But Andrew could come in and reset his positions daily. Maybe that's the adjustment that he will come up with or needs to come up with. But I think another thing too that bothers me is he's not using small bet size. 14 is not enough markets, and he's relying too much on the back test. Yeah, I think that's probably ultimately one of his problems is that he has concluded this is how I need to do it. I don't even have to worry about it except weekly. And then I can do it with 14 markets. And so both of those are probably conclusions reached from over reliance on a back test.
Hi guys, it's good to be here. Hello everyone. So, with the help of this conversation, I was asking recently. The question is, what is trend following and what does it stand for? Okay, and we can say many things about trend following, surely, but one of the things that stand out for me is its non-dogmatic approach to markets and trading. So this non-dogmatic approach, when we look into this recent reversal of credit trading in March, double digits negative performance. If I think the non-dogma that I'm referring there is this month-end cutoffs and year-end cutoffs is we don't have to bound by those rules. This is what accounting requires you to account for it. But when trading, why do you care if it is the first of the month or the 31st of the month or the first month of the year or the last month of the year? So really what matters is what have you done? What sort of an asymmetric benefits that you had in the last 18 months from credit trading? And if it is positive, all right, fine. There will be some reversal, so be it. So it's very important to keep the performance for the last 12 to 24 months and even maybe last 5 months. So I really think that non-dogma in this case means that breaking down the barriers at the month ends and at the year ends and looking performance from that perspective. Now, when it comes to the trading alternative markets, I think I was fascinated by the conversation. I need to admit, it was fascinating conversation, all right? And the main thing is to be able to trade alternative markets, and alternative markets are mainly emerging market exposures. There are some alternative markets in the developed markets as well. There are a few carbon emissions, some natural gas, some wheat, so on and so forth. But the main benefit is, of course, this non-dogma of trend following means that you're going to trade those alternative markets, which means you're going to trade emerging markets. So you're going to trade Colombia, you're going to trade Brazil, you're going to trade Turkish exposures, Turkish interest rate swaps. So if you have enough capital, why you're not trading Chinese Chinese commodities. Well, it is operationally cumbersome because you need to, go through OTC and you need to have other legal documentations to ensure that your money is safe. Yeah, but I think in that podcast that they have emphasized that trading alternative markets will require smaller bet size because they are less liquid. So that's number one. And number two, it is going to be operationally inefficient. So there are two things to consider here: even smaller bet size and operational inefficiency, and that can be done. So that is not a that I think that's what non-dogma of trend following will require. And finally, when it comes to using stops and not using stops, oh well, I sometimes make a joke and say that volatility management is a mean reversion property. Because you're cutting your winners short and quicker. And actually, when you look into it, using stops is the same thing. Using stops is a mean reversion property. You know, in an ideal case, I believe a trend system should not have volatility management, correlation management, but a trend system should not have a stop either. You're cutting the possible trend quicker than it's supposed to be. So, even though I know that in the classic sense, even though we have accepted using the stops, in my view, trends work better and we give more room if we don't use stops. Just a few comments. Thanks a lot, guys.
Oh, Richard, what did you think about my thoughts on BMF?
Yeah, Jerry. Look, I did a quick analysis with Niels looking at DBMF, and I was sort of interested to see if we talked about it last week, whether or not they're decoupled from the CTA index. And look, from my analysis, I couldn't actually see that they had decoupled, but they certainly had a lot more volatility. And I suppose Niels did raise a good point. Well, they have effectively a 70% higher drawdown than the CTA index, yet their CAGR is sort of marginally improved because of their low-cost offering. But, when I'm looking at their volatility, I'm then starting to think to myself, well, what about that Tuttle program that's, I think it's 2 times DBMF? What would the volatility of that one be? And what would the CAGR of that one be? But, you start seeing how, I've sort of picked up a bit of confidence in that it's best to always trade the primary strategy as opposed to a replication process, because I've seen quite a few studies. There was one put out recently, which was looking at 2 forms of replication, which certainly seemed good from a sort of backtest perspective. But, I've always got my concerns with a method that replicates and, effectively lags the decisions made by the underlying programs, because, you tend to, your hands on the control levers tend to be dependent on what these other programs are doing. And with these replication programs, I think that they're inherently slower to make their decisions, and that inevitably is going to make them more volatile. But that's sort of my comments, really. Jerry, that's all I can really add.
Yeah, I agree. I think he needs to consider making some improvements. And however, I think that it's not like, as you and Niels were saying, it is some sort of democratization and gives the average guy and gal the ability to invest. And I don't think that there is a product that competes with it. It's a theoretical index that's sitting there that no one bothered to make available to people. I don't know if that's ever been discussed. I think I've mentioned it and no one's corrected me. So it's out there, and it is getting people some trend following exposure in an ETF. So I think that is valuable. People like it, and it did do really well last year. But yeah, that 70% number is kind of an eye opener.
Jerry, how hard is it to set up an ETF? Do you have any knowledge of that? Or maybe Moritz has knowledge of that? How hard is it to actually get an ETF up and running? So let's say we wanted to create a fund of funds structure and turn that into an ETF. So it's our fund of funds structure of classic trend following. Is it hard to set up an ETF structure for that?
I think relatively speaking, it's not that hard. There's so many of them. There's so, that that right there shows you that it's probably not as hard as it needs to be. I think there is some challenges as it relates to getting a market maker to, and we're going to come out with an ETF in about 3 or 4 months, and it took us a long time to find a market maker who could handle 300 markets, who could handle stocks and futures at the same time, like make a market in these in this ETF, but it's got stocks, it's got futures, it trades all around the world. Some of those markets are closed. So that bid offer spread and making a market, creating shares for clients is a task. And you have to show your positions. Obviously, the market maker needs to come in and put on the opposite positions that Andrew has on, for instance, and make this market. So it's something I think that with technology and experience, it's not that difficult. These people know their business and know how to do it. And it just took us a while to find the right groups that could do this. We're going to attempt to do a similar portfolio with less risk for the retail crowd, and then probably a few less markets, even though they're not telling me that I'm going to have to trade. I can still trade all the markets I want. So so I'm planning on the Chesapeake program to launch a very, very similar 300 portfolio. It's more than 300, but so it's going to be quite a hassle for us. And you could, if you're successful, you could get additions every day and have to go in and do 300 of these adjustment trades to take into consideration your new assets coming in or leaving, of course. And so my traders are very uptight about how we're going to pull this off.
So do you need to trade the underlyings, or for instance, could you create a fund of funds structure? And let's say you are lucky enough to get 1 billion invested through your ETF structure. Couldn't you invest directly into say there was 15 or 10 programs that you wanted to allocate to? Couldn't you invest directly into that through an ETF structure, or do you have to trade the underlying assets themselves as though it was mimicking what those funds were doing?
Yeah, you can't invest in the funds themselves. You're not 100% excluded, but maybe you can have a 5% of the assets can go, 5 or 10% of the assets can invest in a private fund or something like that. So it's the market making. If someone wants to buy your fund, they put a bid in, and there's a market maker who makes a bid on your ETF. And that market maker has to know all the positions and take the opposite positions, like so he can make that market and make that small spread. So
That's
I'm
right.
not an expert on all of that. Oh, yeah, go ahead, Moritz.
Yeah, that is correct. So Richard, you can create a fund of funds like in a hedge fund type of structure, right? So if you wanted to come up with an alternative fund that buys Alpha Simplex and TransTrend and all the other managers which are included in the SGCTA index, and they're included in the index because they are still open for investment, right? So they would take you on board, I guess. Then you could do that, and then you'd pay the fees and everything, right? You wouldn't get the cost reduction benefit that DBMF has, and all of that, and you would probably charge a fee on top. So that is why I guess a lot of investors probably wouldn't like that. But putting that into an ETF structure is actually not feasible because, as Jerry was saying, you have the authorized participants and the market makers that need to make a market on the holdings of your fund, and they need to be able to create and redeem, so have a creation and a redemption basket of the underlying assets, but they wouldn't be able to do that on the actual underlying CTA hedge fund because there's no daily liquidity on them, right? They wouldn't be able to day trade Alpha Simplex or Transtrend. Maybe they could do that on a monthly basis or something like that, but they couldn't be doing that kind of like intraday. So you would then have the NAV of the fund decouple from its market price and all of that type of stuff. So that's not great for an ETF. And as Jerry was saying, it's, if you have the liquid underlying components inside the ETF, so the Treasury note futures and the S&P futures and all of that stuff, and you know what the holdings are, or in Jerry's future ETF, you know exactly what the holdings are on the 300 markets. It's that many shares of stock X and that many shares of stock Y and that many futures contracts of whatever treasuries. And the market makers know that, then they can price it, right? They can put that in an Excel spreadsheet, or they can put it into code and say, this is exactly what that basket is worth at exactly that point in time, given current market prices. They would charge a little spread, and they would essentially create and redeem exactly that basket against ETF shares. And this is how that works. So it's doable with the underlying liquid components, but you wouldn't be able to do that with the actual funds.
Many thanks, guys.
Hi guys, I don't know if you can hear me well, but I was wondering, what do you think will happen to this kind of product in a situation like, for example, the decoupling of the Swiss franc, given that it doesn't have a stop loss? And I'm not saying that something worse than to another CTA would happen, because I lived through that, and I was maybe lucky to get out with my stop loss, which was very near the price when they decoupled the Swiss franc. But I was wondering, something that trades once a week and doesn't have a stop loss, if that would be too dangerous, or it would be the same kind of danger that another slow CTA will have. That's one of my observations on the product, but maybe it's not something different than others. And another thing that I'm really thinking a lot lately, and I think Moritz just spoke about this, is that when you improve the number of contracts that you're trading, at the end, you need to get into some kind of credit risk, because you are going outside of the CME, so to speak. And that's something that always, making me stop adding new markets. And I don't know if you guys care much about that or feel comfortable, but that's something that lately it's been some kind of concern to me. The credit issue being to trading anything that has non-CME credit risk, because I think the CME is such a pivotal part of the system that it will never have such a huge problem that would be only my problem. But when you go outside of that kind of great risk, I think it's far more dangerous, but maybe it's an old-fashioned way of looking at it, and it's not that much of a problem now. Thank you.
I mean, all investment banks have been trading OTC markets for decades. It's just a new concept for futures trading hedge fund space. The fact that, these alternative markets are actually mainly OTC, and you need to move out of the futures markets. The markets are there, and I think this journey and this trend following products overall, when you look into it, it just makes more sense if you can add these alternative markets, trade smaller, and become more diversified. Who doesn't want it? But I mean, the only question is, how are you going to cover yourself, and how are you going to cover those legal obligations to be safe? And there are certain things that you need to do differently in your processes, and that's pretty much it. If you want to trade New Zealand IRSs, or Chinese commodities, I think it's going to add huge amount of diversity, and you will be trade even smaller than what you're trading today, isn't it? That's what we all nice, what we all want, smaller best size. Thanks.
Well, I think to answer the first question from Kurdura is, look, Andrew has a stop loss to the extent that those 20 CTAs have a stop loss. And they go around talking that they don't use stops. So maybe some of them do, maybe some of them don't. Maybe it's really, as a group, do they use stop losses? And they don't like these stop losses. I love stop losses, and I don't agree with Al. Stop losses are a part of trend following. And it's not making trend following less to use a stop loss. And they brag that they don't use stop losses. They don't need to use them because they're doing this constant daily stirring of the soup pot to reduce, add, subtract positions all the time based upon vol, correlation, risk. They'll get to the right position, the risk-adjusted position that they want. I complain because they're doing too much reduction. They're not letting profits run. They have too much risk control. They're risk controlling the outliers. They're not having the loose pants enough with those open trades. And so I don't know if they have a trouble with the losing trades. It seems to me that they're doing too much of this risk control, and they're effectively not. They want to brag that they don't use this stupid ATR-based stop loss, but they're doing something to mitigate. They're on steroids on this obsession with mitigating as much as they can, not only losses but fluctuations in their equity. I think they don't have a problem taking care of those losing trades necessarily, but they have the problem is they're locking down the potential profit that they have, and with this constant daily massaging and manipulating of the portfolio, irrespective of it's in a big uptrend, and what we don't like that recent volatility. So Andrew has what they have. Okay, now he's a week late. He only trades the 14 markets, but if he traded all the markets, if he updated daily, yeah, he would probably have a lot less slippage from his benchmark. Mike Harris just posted on Twitter this thing about Andrew's correlated to the SocGen trend index more so than he is correlated to the SocGen CTA index. And that reminds me of a funny story that a friend of ours posted a long time ago, comparing Andrew's performance with the SG CTA index. I mean, trend index. And people reminded him, yes, he has high correlation to the SG trend index, but that's not what he's replicating. So he was kicking ass on both of them, the CTA and the trend index at one point, and he wasn't even trying to, but most of these CTAs trade trend. I don't even know the difference between these indexes. I would never have guessed that we got to have two indexes. One is trend and one is CTA. That right there is a condemnation of the managed futures industry, that you need to have two. I mean, aren't these CTAs trading trend? So confused.
Stop, and I want to say about stop loss. What I think it makes at least for me, it makes my strategy more robust and algorithmic. So I don't know the better way of managing risk, and so it's a part of robustness for me personally, using stop losses. So a part of strategy.
Good morning, Mike.
Hi, Jay. Happy Easter to anyone who observes the holiday. I don't think that stop losses are so much the problem here with replicators like DBMF or CTA. DBMF is down 11% year to date and 20% down from all-time highs. The problem is when we have talked about this in the past, when we had the regional banking crisis, the bonds rallied from flight to quality. And what happened was this ETF was massively short the 2-year note. It still is. It's a massively short replicator in everything except gold, and they develop stocks. So what happened is they got hit with a 4 standard deviation loss, and also the CTA index got hit. I had an article with a 9 standard deviation loss. And this is the problem. Let's imagine, we have talked about this in the past, let's imagine a crisis where the authorities come out, the Fed, the Treasury, and say that we have to increase liquidity or even decrease rates, and they have no stop losses, and they have a lag in tracking the index. So they may be hit with a very, very large loss, and we have talked about this in the past. I don't like replicators. By the way, I think they should have Jerry as a consultant to the product because he's the person with the most skin in the game in trend following. I think it's the risk of anchor point, I'm not going to say ruin, is very high with these products, and they remind me of XIV. They remind me of the removal of the Swiss franc peg some years ago. They remind me of other anchor points in the markets, so they should look into this risk aspect. And life is not always linear or maybe log normal. There are power lows, there are extreme events, and there is high risk. And this is my opinion I have expressed before about the product. Thank you.
Yeah, it's it's early. We'll see how he goes. It's hopefully he recovers and he can keep going and improve over time. I haven't heard from him in a while. Haven't seen him on podcasts in a while. I'm sure that I'd like to hear from him about how he's handling all these drawdowns, and so we'll see.
Jerry, hi. Sorry, I just wanted to say that I made a mistake that you always help me to correct, and it's that I many times I forget that what he's doing is replicating the CTA index, right? Those specific trend followers or CTAs, for a better term, because many times, I forget that, and I compare that to old school classic trend followers. I compare his product to that, and I guess that's not 100% fair. And when you bring that into the table, I stand corrected in saying, of course, the guys who he's replicating must have very loose stop losses, etc. So thanks about that.
Right. I think that's the thing that makes me. That's why when people, I did an interview yesterday with a really interesting guy who writes in a magazine, and he was asking me some good questions, and I always say the same thing about DBMF. And that is, it's funny. It makes me laugh because it's a group of traders, and he's not replicating a product that even exists. It's a spreadsheet product, and it's 20 managers. If he did well, if anything, it could bring business to them individually. But it's very ironic that they've set out to incorporate the idea of trend following into their philosophy that is more traditional, sharp focused and volatility focused, and then they're going to trade. They're going to heavily manage these positions. They're not going to let profits run. They're not trading 300 markets, let's say, necessarily. And if they are, when you get a certain market that is out of control, like the yen last year or the pound, that looks like, or the short-term interest rates that are making a lot more than the long-term interest rates last year, they're going to scale that back because the outlier is a problem. And they turn the yen and the pound and the short-term interest rates into markets that look very similar to the sector. They're making money on the sector moves. We are too, but within the sector, if there's an outlier, like the ones I just described, we're going to get that too. We're hunting the outlier, but we're appreciative of the smallish profits or the non-outlier profits we get in this sector. But what they've done is made it very easy for Andrew to replicate. Easier. Okay. He's lazy. He's taking too many shortcuts. He needs to update it daily. He needs to trade more than 14 markets. Okay, whatever. But he's had some success. It hasn't decoupled. It's the only thing a lot of people, it's an ETF. He's meeting the needs of the marketplace. This is what people want. By the fact that he went from 60 million last January to over $1 billion by the end of the year. I mean, this is ridiculously phenomenal business success. And so what he can't replicate a trend follower who lets profits run because he needs to trade 300 markets. Because right now, we're not scaling back sugar. The sugar is good, but the UK sugar is better. Okay, well, I got sugar covered. I'll just trade the U.S. Well, you don't have it covered. You have it covered if you're going to scale back and vol manage the UK sugar and make sure it looks more like the New York sugar. Sure, you got it covered with your dumbass system, but so he needs to trade OJ. He needs to trade these markets that we have in our portfolio of 150, 300. It's the same problem. And so the smartest guys in the industry, the largest firms in the industry, they're easy to replicate. It's their own fault. And this is what they've chosen. This is how they've chosen to change their trend following. And then he can't replicate me. Little old me, he can't replicate because I trade OJ and sugar. So I think it's kind of funny. It's hilarious. And it makes these people so mad that they badmouth them. They put out half-truths. There is plenty of truths and we've talked about it. Who's been more about it than me? I've already said. It's a problem. It's not like what I do. If you don't do what I do, you got a problem, right? This is what all CTAs think, because we're very prideful and we're very protective of what we do and our philosophy. And so obviously I trade 300 markets. He trades 14, So I stick with what the one thing that I think about when I think about Andrew is it's funny. I love it.
Jerry, the ARKK ETF is 75% down from the 21 highs, but it has made $300 million in fees since 2015. It needs about a 290% gain to recover the highs, but the fees keep accumulating. People pay for one reason or the other. So, I try to differentiate between compensation schemes and absolute return schemes. And the problem with the replicators is that replication is very easy. There are two types of replications, the top-down and the bottom-up. The top down is to try to infer the positions from the index. This is what they do. There is also bottom up, and I had an article about a month ago. I don't know. I write so many articles. I should stop. And where I have a bottom up application of CTAs, and they are both very easy to do. Extremely easy. There is nothing extraordinary in replication. The marketing is hard to get the ETF accepted and in major platforms to market it. And this is the idea. Anyone can make, with linear regression, a top-down ETF to replicate CTAs as long as Societe Generale compiles their index, or some other people compile their index, the Berkeley heads and everyone else, and they can do that. There is nothing unique here. And if you look at the positions of the DBMF, they have still 7 contracts massively short in fixed income, which, in my opinion, may have some high risk, in my opinion. I may be wrong. Okay.
I was gonna make a comment on the first things you were saying, but I forgot what you said. Yeah, it will come back. It's a great idea. I just think that I don't really care so much about the managed futures and this particular form of trend following they do. I'm very eager to compare classic trend following to managed futures CTA trend following, and this is the battle. This is where the rubber meets the road, and the big problem is that it's so hard to follow these systems that have loose pants and give profits back, and that don't make correlation and smoothness the priority. And so I just want to keep going, and I'm really happy that it doesn't look like I have anything to be jealous about as it relates to, except for their AUM, of course. Oh, I know what it was. I wanted to say something about ARC. Yeah, that's what I wanted to mention, and you brought up a very good point about their AUM as it relates to their performance. And I think this is another good lesson in that she is a leader of a cult, and so like, it's Bitcoin, it's ARC, and I would like to have a cult of trend following where the same thing could occur. And we bemoan that it doesn't. It's talked about all the time. We have to do these suboptimal things because we have to. So I didn't like that statement that Aspect guy made about its trend following is this bitter medicine. I didn't like that because he has a solution to this bitter medicine of trend following. It's non-trend following, and it's changing trend following so it's more palatable. And we got to do it. The clients demand it, which I think is bullshit. I mean, I think that these people who trade this managed futures CTA strategy, they love it just as much as they've convinced the clients to love it. But it would be great to have a trend following fund that has these incredibly nasty returns. Not just like ARC, but similar. And you just see people flocking to add money because they love trend following. They think it's just amazing. They understand it. They love the diversification. They don't need it to be smooth. They understand why it's not right for it to be smooth and how much better it can be if you have one entry, one exit, and a stop loss, and you're trading as many markets as possible. And you're going for the smoothness from the robustness point of view. There is no diminution of robustness. There is no over-optimization when you add more markets. If you're increasing your smoothness and it's something other than adding more markets, you got to be very careful. I mean, that's the understatement of the year, right? You got to be careful. So I think that I remember hearing about this firm out in, I think it's California or Texas, and they would require people, they would invest in small caps only, and they would require the brokers. The clients had to go through a broker, and the brokers had to come out to the firm and learn and absorb and believe in this strategy. It was like a religious experience, and this is what we need for trend following. We need to find these clients and find like-minded people who you don't have to educate them. When I was 25 years old, I read about trend following. I loved it. I've only loved it more each day since then, and I'm way over 25. So that, I never questioned it. I thought it was the most wonderful thing ever. And the more that I learned, the more I loved it. And so this is how you get performance. You get additions, and you get clients, and you get assets under management, regardless of your performance. Now, she's trading a bad strategy, so that's kind of a bummer for them, but we know better. But I think this is like the ultimate, is you want to speak to these people, speak to their hearts, and get them to understand. And unfortunately, I think for diversified trend following, it's probably like 1% of the population who can really enjoy the drawdowns and just the way the whole system, the whole way that systematic trend following works.
Jerry, I don't want to monopolize. I haven't been to the space for quite some time because I had a workload. But I'm going to say a couple of things. Trend following is very easy. Over the years, I have tested hundreds of papers, positioning methods, entries, exits, anything you can imagine. And I have realized, I came to the conclusion, the simplest entry, like a 150-day breakout, one entry, one exit, and sizing with an ATR is the most robust system. And all the other systems are care-fitting on past data. The problem of trend following is that, let's be clear, you are an outlier. Jerry Parker is an outlier. Many people tried trend following and failed. Why? For many reasons. There is the discipline. There are many details you have to deal with every day. And people should not underestimate the rollovers. And if you are dealing with 100 markets and everything else that changes all the time, and tracking and making sure your finger is not fat and making errors with entries and exits. And all these things are very difficult. And then comes the marketing, which is also extremely difficult. So some people became outliers in this game. You are one of them. Congratulations, we always say this, but it's not easy. And the simplest system is the most robust. All the other systems, these pragmatists, these people about volatility targeting, adjusting dynamic stops, all these things fit to past data. The regime change and these things don't work. These methods don't work. They fail. And of course, going to replication, in my opinion, it's kind of a naive approach to trade the futures markets, but that's my opinion only.
Yeah, thank you, Michael. That was great. I think it's just a bad trade-off, right? It's a bad trade-off. That what am I missing? What am I losing by wanting to have the best, most robust? When I decide how I'm going to put everything together, what I'm missing, it's going to be bumpier. It's going to be bumpier. it's going to be less smooth. We're going to make less money. No, I'm not. I'm not going to make less money. They're not going to be able to beat the most robust ideas. And these ideas are not mine. They're for everyone. It's a choice. One entry, one exit, and a stop loss. He's already told you the 150-day breakout. It's out. Okay, one of my secrets is now out. It's wonderful. It's beautiful. I've traded it for many years, and I'll continue to trade it. I look at to some degree, it's not a perfect analogy, and I know it'll be mischaracterized eventually, but I look at this turtle trading breakout method as sort of like the S&P. You hear the rules, you see these rules, you can do the rules yourself. You can invest in the S&P. You can invest in classic trend following. You can do the classic trend following yourself. What are the characteristics of the S&P? It makes money, and it's very hard to beat. And it's in the public domain. Anyone can do it. People try to beat it all the time. It's their life's mission to outperform the index. Super hard to do. Over time, I'm not sure who does it or how many people can even do it. I think it's very similar to this. We have an edge. We can go short. It's going to be much better than the S&P, but the essence of it is the same. Yes, I can beat it if you let me use Sharp. This is why they talk about Sharp so much. And yeah, it's what Bruno said. What else are you going to use? Bruno said he was more adamant than on Niels' podcast than all the other CTAs. They kind of badmouth vol Sharp ratio to some degree. It's not that great, but they use it. They all use it. Doug said this vol management and getting out of these positions and not waiting on this trend following approach because it can't be relied upon and trusted. Look, that's only if you pay attention to volatility. You're not going to be able to outperform that robust trend following breakout exit. So I think it's naive, and it's coming from very smart people and very PhD people. And what they're essentially saying is, isn't it just amazing and wonderful that the ultimate risk measurement we can just see from a performance table? We don't have to dig any deeper. Might there be something going on that you don't see on the performance table? No. It's all right there. This is all we need. You can measure everything. So people are just measuring, using a measuring stick where the information is readily available, as if there could be nothing below the surface, beneath the hood, whatever cliche you want to use, that might give a better indication of true risk and true risk of losing capital.
And I want to say that I see everywhere in very different sources, business sources, psychology sources, philosophy, the same things. And for example, today I was walking near the sea and listened to audio book by a business author, businessman Naval Ravikant, and he said that to be successful, it's very important to have good upside, unlimited upside, and not to have a risk of ruin. And I thought, it's about trend following. We have unlimited upside, and we have a limited downside. So in our good risk management rules, we don't have any risk of ruin. So trend following rules, as I always say, can be applied to every field, almost every field I know, and it will make us successful in every field, almost every field, then I know. And for me, it's a big sign to laugh. Why I understand why I laugh trend following that, and I fall in love in trend following when I get known about it in 2008, because it's wonderful philosophy.
Jerry, I think that this is what happened, in my opinion, and in my experience. Of course, I may be wrong. When you get an AUM of $1 billion, you are looking for ways to preserve capital. You don't want to lose the AUM. If you make 1% management fee, that's 10 million. So why sweating to make any returns? Not many are going to leave. If you don't make anything for a year, say, oh, we didn't make anything, we didn't lose anything. So you get your 10 million. And this is the reason, in my opinion, for the lost decade. After the 2008 convexity, the money came to manage futures. And then these managers thought, why taking excessive risks? We can target the volatility. And then we make the fee. If we don't make money, it's fine, but let's not lose money. So you had 10 years with flat performance for the CTA indexes. And this is what is happening. And you are on the other side of this cult. You continue to try hard, making absolute returns and outperforming the indexes. So what happens? 1 year you lose 10% and all these people leave to go to the guys who make nothing for 10 years, but they don't lose anything. And of course, this is the stupidity of investing. Sorry for the expression, in my opinion.
I don't agree with Niels. He's very adamant about that incentive fees are the only way to go, and the client, the manager is aligned with the with the client. I think it could be somewhat true, but I think the majority of the overwhelming majority of investment management is done at a fixed fee, 1% or less or something like that. So I think these people are very competitive. Clients are very short term. They're looking to pull the trigger and get away from an underperformer as quickly as possible. And so I think people are very intense. If I was trading with no clients, and I would be very competitive. I'm very competitive. I think all of these CTAs are incredibly competitive. They're very they love their philosophy. They argue and they take pride in what they do. So I don't really think that. And then there's been many studies, a handful of studies done that I would rely upon that said, look, during this period, it's very simple why the CTAs underperformed. We went through a long period where the studies showed that we didn't have enough outlier trades. So I would go with that. And as soon as we get the outlier trades, starting in 20, 21, and 22, we kick ass. So regardless of the fee structure, everybody's doing well. If you have a big incentive fee or you have a management fee only, everybody was doing really well when those trends came back. I do think, though, that you're right, that we're all influenced by the business side. We talk about that a lot. We're influenced by the fees, being underwater, making the payroll, and greed. And so I do think that you can maybe rest a little bit if you're getting a management fee and maybe not improve or maybe underperform for a while. I agree with that. Of course, someone on this planet is going to take advantage of that. But likewise, there's bad incentives if you use incentive fees. It's to overtrade. We're down so much. If Kathy Woods was incentive fee only, what would she do? She would be go for it. What do we have to lose? We're not going to make any money for a while unless we overtrade, take too much risk. It's the client's money. We're not going to be charged for these losses. We're only going to make it if we make money. So let's overtrade, trade large, take big risks. And so we're human beings, and none of these fee structures or combination of fee structures could possibly, in all situations, overcome human beings behaving badly. So it's not a magic formula. I think the best magic formula is to find someone who you like their strategy, you like their risk appetite. It's high or it's low or it's medium, and they have a lot of their own money in the fund right alongside you. Now, once again, you could be in a fund with a psycho, or you could turn psycho. And so you don't really know. Nothing is going to prevent bad things from happening all the time. But I don't think, no, I mean, it's the lack of trends. AQR has written papers, other people have written papers that show that during that period of zero interest rates or Fed manipulation or whatever, that we had a lack of trends and it had nothing to do with the Fed. Whatever idea you want to come up with, that's the bottom line. In evaluating systems and evaluating trend following, I would suggest that you look at it on a trade by trade basis. Was I getting chopped up in this particular trade? Did I miss out on trend follow? Is my system too short term? There were trends, but I was too short term. I kept getting whipsawed. There were trends, but I was too long term. I made the money, but I gave it all back because my trading stop was too far away. So, but when you don't even have the opportunity to have these big trends, you can't expect anything to happen. I think CTAs could have mitigated that somewhat and could mitigate that in the future by doing what? By doing what I do, right? Of course. I've got it all figured out. You got to trade more stocks. You got to trade single stocks. You've got to not put managed futures first. You put trend following first. And whether it's a futures market, whether it's an over-the-counter, swap, counterparty risk, security, ETF, stock, whatever it is, take your trend following to the world's markets, and trend following is primary, not managed futures. It is like laughable to listen to some of these guys who will say, one of them, I don't trade any stocks in my managed futures portfolio. It's managed futures. And the clients don't want stocks. But I do trade 5,000 stocks in other programs. Oh my God. Love your trend following. Make it the primary and the best program you possibly can. And the mismanaged futures industry has totally turned their back on stocks and massive diversification. And these clients they don't need a 5% allocation to CTAs as much as they need to have a lot of stock exposure with trend following wrapped around it.
Jay, what is your opinion? I think the management fee should be outlawed. And then you will have a reduction in the industry by 50% because all the bandits will leave. And then you only have the people who actually do work. What do you think?
Well, no. That made me laugh. I mean, I try to be radical and say crazy things to get people excited, but you're able to beat me at that today. No, I mean, it's interesting. I'll think about it, but my guess is, Michael, my guess is that the CTAs with the lowest incentive fees have outperformed. They've outperformed over time, and they will outperform in the future. The lowest incentive fee, because it's such a drag, and it's way too much money. Okay, you're aligned in some way, not as aligned as well as if the manager, and some of these managers with high incentive fees, they have a lot of their own money in there. So they're aligned perfectly because I value that investments that they would make in their own fund much higher. But these incentive fees are pretty dastardly, and they probably hurt compounding quite a bit because most of the CTA incentive fees are probably quarterly. And so you get out, you charge this big incentive fee at the end of the quarter, and then you go on a drawdown and for the rest of the year, and that's going to dramatically hurt you. I think a small management fee or management fee only, or a small management fee, a small incentive fee, what you're underestimating, I think, and I may be overestimating, is the competitive nature of people, and they're going to try their best if it's a management fee or an incentive fee. The incentive fee is a bad number, and it hurts compounding tremendously.
Yeah, I think it's just rationally completely contradictory to the ethos of any systematic approach to apply an incentive fee for when outliers take hold and you're making money. You want to keep, the management fee is the fucking incentive fee. The incentive should be keep your system the same, and that's what the management fee should encourage the fund manager to do. I mean, Andrew, to bring him back real quick, I mean, I understand the shortcomings with stop losses and sort of the structural under the hood, shortcomings compared to say a Jerry, but at least he has popularized the approach and put it in the consciousness of enough people that hey, some of them are going to stick with it. But over the past month, there's been 100 million in net outflows from PBMF, so he's fallen well below a billion just over the course of the last 3 months. So yeah, I mean, I totally agree with what Jerry said about the incentive fee stuff. But a lot of people don't have access. A lot of people aren't privileged enough to have access, even to mutual fund vehicles that are superior, like EQCHX and the like. Just even though it's a small initial investment requirement, but at least he's offering a solution to everyone that is pretty damn competitive and has positive skew. That's all I got.
Well, under management fee, the optimum strategy to make money is to become a marketing organization and don't take risks. Capital preservation. And this is what is happening. And then you have these firms that amass all this AUM and they charge the management fee. That's my rationale for saying there should not be management fee, because it facilitates this path of marketing. And then you have all these people in the podcasts saying things that defy basic logic to market their products. That's why I'm saying this. And I think Jerry will agree that this is happening.
That's why it falls to the investor to seek out managers. It's hard. I mean, people have to do their homework, but it falls to the investor to find somebody who does not have a track record of, every time their fund is experiencing losses on a year-over-year basis, they tweak stuff and whatever. I mean, you look at Chesapeake and since inception, it's yes, it's evolved, but that it's a slow evolution based on a thoughtful shifts. So yeah, I mean, I agree with you that a lot of it goes to marketing, but not in the managed future space. Otherwise, we'd see a lot more in the way of capital flows. It's a very small market, much smaller than it should be. But I do agree. I do agree with you. I mean, there's no perfect solution, but incentive fees are going to be used for marketing as well. So I mean, I don't know.
Well, Jerry can correct me, but I think four CTAs have more than 25% of the AUM. Is that correct, Jerry?
Oh, I don't know those numbers, but yeah, it's those 20 CTAs probably represent, I don't know, a large percentage. I don't really know their AUM. It depresses me, but they're very professional organizations, very put together. It probably, I've heard this cliche before, it reminds the allocators of their own firms. And so they're very good. You see, when I left Richard Dennis, we were fully equipped with the best way to trade and the best philosophy of trading, and a philosophy we were taught to survive for the next 50 years, not here are systems that are going to work for a while. No, from day one, it was, look, the systems you have now, they may continue to work, but you have to change, evolve, the markets are going to change, and we're going to teach you guys how to last a long time. And they had this brilliance of computer skills and backtesting skills, and the experience of being in Chicago and trading on the floor, and they were able to combine this theoretical world with this practical world. And they were heavy into math and computers. And Bill Eckhart is probably the smartest guy I've ever listened to. I mean, you listen to Bill and you're just like, oh, crap, I thought I was a smart person. He's on another planet, and Rich as well. I mean, that's the lesson of the turtle. The takeaway of the turtles is those guys were geniuses, and they prepared us for the rest of our life. You just had to follow it and understand it and believe in it. And so it was easy for me to not deviate too far. I did deviate. It did cost me time, money, and clients. But, you know, we had everything that we needed. Now, the part of the Turtle program was clients are going to drag you down. You know, clients are to be kind of avoided. And so we had a chip on our shoulder about clients because we had to do the right thing. We had to do the hard thing. We had to follow, and clients were just going to help you try to convince you to not trade your system or alter your system. And so to say we didn't have marketing, we kind of had anti-marketing. And these other guys, oh yeah, and then this guy at Aspect, you know, he continues to misstate and call and characterize the turtles as Richard Dennis was in the pits and they systematized his pit trading, and then we come along, us PhD Europeans, and we show the world how it's done. A lot of that they have, they've got lots of assets, they got great businesses, and the AHL guys came out of a very large corporation. They're smart, they're PhDs, they're physicists, they're scientists, and then they had this training or this experience inside of a large organization whose job was to collect assets. And so they have combined their knowledge and the trends and their science with being great businessmen. And the turtles kind of like, their heads are spinning. Nothing. We didn't meet our expectation. We could have done so much better, so much more. All we were left with was amazing, better ways of trading. So I guess I have to be satisfied with that. And I went to a great business school, so it's kind of shocking how poor I was at kind of running my business. And they're correct to some degree. You need to appeal to people. You can have this strict orthodox approach or any kind of approach, but if you're not able to convince clients to give you money, it's kind of like, what are you doing? And so AHL crowd versus the turtle crowd, it's interesting, and it's just a lot different strategies and upbringing. I think the turtles would have been a lot better if we would have had, instead of 4 years with Rich and Bill, 14 years, and more time. We got out of there too quickly, and we didn't know anything about creating these. At least I didn't. I wasn't able to create a business that was going to last with a long time with billions of dollars of assets. So that's my little summary of all of that. I wouldn't trade my experience for theirs, of course, and they wouldn't trade theirs for mine. But I do think that people underestimate how the smartest guys I've ever heard in my entire life, their main thing when it came to teaching us about trading was sample size, robustness. I never even heard of anything other than one entry, one exit, and a stop loss until we were invaded by the European CTAs.
What about making a management fee if you cover the risk-free rate? And nowadays it's high.
Yeah, I'm all for any of those type of hurdle rates, and something I think it's coming back that my first 1988, my first fee structure was 2 or 20. So I got the 10, but you had to subtract that 2% management fee payment from the amount that was due from the incentive fee. So it was essentially 0 in 20 as long as you made 10%. So and that worked pretty well. I'm sure I did some lower fees later as well, 0 and 15. But the one or structure, or the management fee or, is a pretty good. I've seen that pop up recently. That's a pretty good structure. I think the best structure is like 1 and 0, 2 and 0. I would rather pay 2 and 0 than a big incentive fee. My clients, I give them a choice. What do you want your fees to be? And they always ask me, what do you think I should choose? And I'm like, well, I would choose something that's heavy on the management fee. If you think you're making a good investment here, you're going to pay less to me. Trust me, you don't need to spend 5 minutes with me to know that I'm putting my best foot forward every day, not only because my money is in there, but because I want to do well and I'm competitive. And I love that money that I've made over the years in incentive fees, but it's definitely not driving me to perform. So I think, I'm more of an management fee guy, because it's going to work out best for the client if the manager is successful.
It reminds me of giving equity packages to employees. It's a diluted, weird. Conceptually it sort of makes sense, but in practice it doesn't. Like you just said, Jerry. I don't think it. If you're a good person who's sort of an artist, to use a lame phrase, but you're passionate about what you're doing. You're not thinking about the incentive. You're keeping your system the same because that's the prudent thing to do, and that's going to compound money over time. And I just think it's crazy. I mean, 85 basis points, by the way, for Andrew's fund is pretty good, and Jerry's is crazy well priced in the public space. And yeah, I don't understand why you would pay for anything but the process. You pay for the process, not for the result. It's a complex adaptive system. You don't know what's going to happen. Pay a manager for his process so that he keeps the same damn process, and you can depend on that, as opposed to paying for results, which they have no control over.
Niels, in a podcast, said once that he argued that if the AUM increases, the management fee should go down. What do you think?
Well, I think that would be something that business people would calculate, whether that's going to overall increase their revenue by being that type of firm, that they may say, well, we could actually show the world what great people we are, that we could reduce our fee and get more AUM. One of the things about CTAs, though, is there is quite a limit to how much money you can optimally trade. So people choose not to trade that optimal number. I hope my ETF is successful, and I hope it brings in money to the private fund as well. So I hope that I get rewarded for trading 300 markets, classic trend following, creating an ETF, etc. But wow, I really enjoy trading all of these 55, 60 commodity markets, some of which are not very liquid. If I was trading $1 billion or $2 billion, so you'd have to make that choice, right? Or you say, okay, I'll take those out of the management fee product, and I'll trade those liquid markets only in the incentive fee product. You can do something like that, but there is a limit to how much you can trade, especially in the commodities markets. And the commodities are really wonderful, perfect, beautiful markets, and they add so much diversification and profit that you would hate to do that. But essentially, that's what people have done. Even if it's I have traded grain swaps because the position limits were too low compared to the liquidity and the volumes. But then at some point in time, if you raise too much money, you're going to get too big and you're going to run yourself out of those commodity markets and trade gold and crude only, pretty much. So you don't want to kill the golden goose. But I think that's what, somebody even said the other day. I remember saying that, the largest mutual fund manager in the world is a nonprofit. So Vanguard continues to cut fees. Yeah, I think to some degree as well, these big hedge funds, they keep raising fees and making it tougher for investors. And it sends a signal to the client that you should be lucky to be a part of this fund. And it's a marketing gimmick where it sends a signal that, high prices sometimes can send signals of value, even though it may not be. And so I think the race to the bottom of low fees is probably defeats itself sometimes. I'm amazed at how different people do it. Let's raise billions of dollars in an ETF, or let's raise billions of dollars in a hedge fund with high fees and restrictions on redemptions. Yeah, I'm very confused by how all this works. All right, I wanted to give Richard and Moritz a chance to say some parting words before we head out. I don't know if you wanted to pick up on Doug grinning, Moritz or Richard, if you're still awake.
Yes, still awake. It's fun. Maybe the one thing that I was a little bit confused about, and he mentioned that, like the volatility breaking or the volatility increasing at the end of a trend. Yes, but it kind of like, maybe I need to re-listen to it, but it kind of like came across that he could better manage that, or even forecast it, or get out of the position when the markets turn, in order to avoid that give back. And it's just, so it's a profit taking dynamic position sizing thing again, where I guess he's looking to reduce size when the position goes against him, and then maybe becomes a little bit more volatile. But if you wanted to generalize that across all the markets that I trade, and looking at that in my trade distribution and the trade statistics, I just don't see this to work. But he didn't give me the specifics, or he didn't give us the specifics of how exactly he does that. I mean, obviously that would be fantastic, right? If we could sniff out when the trend's over and get out, but we just can't. And I could give you so many examples where, as a person, you think, oh, that trend is cooked. We're done. We're now going the other direction. That's over. And you give back the P&L. It kind of like, it almost goes close to your exit, but then it turns around. Like magically, it just goes on another leg higher, and it makes you more money, and it makes new highs, and you're still long with the original position size. I mean, this is part of the data. This is part of the distribution. These weird things where it's very close to the edge, or close to the exit. You're close to being kicked out, and you're looking at the not yet realized loss and all the stuff that you've given back, and then it turns around, and you don't. I guess Doug wouldn't get that in the way that I do. He will create these rules and layers and filters and whatever, dynamically position size out of it. And I think overall that is probably something that leads to less robustness rather than more. Yeah, those are my parting remarks. But overall, I enjoyed listening to him, because you don't hear him that often on the podcast circuit. I mean, there's a couple of names that come up over and over and over again, but I haven't heard from him for a couple of years, so that was interesting. And yeah, with that, hey, have a very great Easter, everybody, if you're celebrating it. We do it here. See family, take a day or two off, and have some good food, and hopefully have a great trading week next week.
You too, Moritz. I think these have been fascinating, these podcasts with Niels, because there's been certain podcasts where things that have been said that I strongly agree with, but then, other things that have been said that I strongly disagree with. But, in all of these podcasts, I haven't heard one that I would classify as submitting to our philosophy. I think that we are a particular unique breed of trend follower who is specifically focused towards tail properties of the markets. And I'm very happy with the adopted position we've taken, because I just feel that all of these other measures taken for trend following is a different form of trend following. It's focusing more on what can be extracted from more predictable properties of the market, and measures to smooth returns, make it more digestible for investors. I'm very happy with our game, and I'm appreciative of the series, because it's actually cemented more why I am a tail hunter and why I'm very happy to be in this particular space.
Well, I'm very happy that you're in our space, and I've learned a lot from you, Richard and Moritz, and I'm so happy that you're still there on that podcast, because it's you are different than most of the other guys on the podcast, and
I
certainly,
need you back, guys. I need you back.
yeah. Well, I love to. I'm more of a critiquer. I love to listen to those things, critique them, talk about them, tweet about them. And, I can't do what they do, but I can definitely criticize it. And that's where I really have more fun. But I really enjoy when you're on there, and I listen to those things 3, 4, 5 times, get the transcript, and I really learn a lot and listen to every word. But it's a great. And this CTA thing has just been phenomenal. I wish you could have been on there with them, or participated in asking questions to some of these, because that's what we're all doing. We're saying, like, we're listening to these CTAs talk, we're listening to Alan and Niels, and they do a great job. But I'm like, come on, ask them this question, ask them this question. So it's really fascinating to hear all that, and how it reminds me a bit of the popularity of Market Wizards books. And people ask me, like yesterday, the interviewer said, what do you recommend reading wise? And I'm like, Market Wizards. I mean, whatever you can get an interview from a trader, a magazine, article, internet podcast, Market Wizards. These traders, they have so much wisdom. They'll talk too much. They'll give away little secrets, and just file those secrets away until you can understand fully. Don't reject it, but say, okay, smart guy, maybe he has something here. And this is what I've done my entire career, is say, okay, I don't understand what this guy's saying or this girl, but I'm going to file it away until I personally become smarter, so I can kind of say, oh yeah, I see where they're coming from, and I want to refine my trading worldview by putting myself in front of smart traders who talk too much. And so it's really, really fun. What a great service to the industry that people can go back and listen to all those things, and hopefully you'll do more and more. Okay, there's more to be said, but we've run out of time. And happy Easter, everybody. Happy Good Friday. And we'll talk next week at the same time, Friday at 8 a.m. Eastern Time. Thanks for being here.